Hello students, welcome back to the class. Economics chapter number 4 and we are continuing with the topic of the functions of the commercial banks, right? And in that we are understanding the primary functions of the commercial banks. In the primary functions we understood about accepting deposits which are consisting of three main types of the deposit and one subtype of the deposit. The second was providing the credit facilities, that means to provide the loan and all. And the third one was payment and withdrawal facilities, right? That how the payment is being done on behalf of someone and how the withdrawal can be done. In today's session, we are going to conclude two more points, right? And they are the part of the primary functions. The fourth function is the credit creation, right? And the fifth function is going to be the interbanking transactions. So at first, let's check it out. What is credit creation? Guys, I have told you before that your deposits are going to be used as the primary fund from which the loan can be given to the people who are in need, right? That means whatever the amount which is deposited by you, from that some portion of the amount will be taken from the bank and will be given as a loan to someone else, right? So it will take a longer time to understand, but at first let's simplify it. It's simple thing that before we start understanding the credit creation, you must know what is CRR. CRR stands for cash reserve ratio. It is basically the ratio given by the RBI and it is mandatory to be followed. CRR, cash reserve ratio, that means the bank can never ever make 100% loan out of 100% deposits. Say for example, any of the bank is having 1 crore rupee as a deposits with them from the different account holders. The bank cannot make the loan of 1 crore rupees, right? There is the CRR. Say for example, CRR is 10%, then the bank needs to maintain 10% of that amount in their hand as a cash, right? That is going to be the CRR. Say for example, there is a bank in which the total deposits are of 1 crore, right? And if the CRR is 10%, the bank can make the loan of 90 lakh rupees, but 10 lakh rupees out of that 1 crore must be as hard cash in the bank and which must be available all the times. So day to day, whatever the balance rises, the bank has to keep certain percentage of that. That means whatever the CRR is, that percentage is to be maintained in cash by the bank all the time available, so that it is not possible that each and every person will come to the bank and say, come on, give me all my money, right? A person will ask for the money, whatever they require. So it is the basic amount which a bank must keep ready with the cash, so that if any account holder come and ask for their own money from their own account, the bank must be able to give. Bank can never ever deny that we don't have the cash right now, so you won't get it, right? So that is the CRR. Now on the base of the CRR, the credit creation is done. So now let's understand what is credit creation. Credit creation means what? Whatever the amount which is deposited into the bank after keeping the CRR aside, that means whatever the reserve ratio is there, that much amount of that account is being kept aside, right? And the rest of money is given to someone else as a loan, right? Now guys, it will be very much interesting to understand that out of a single amount, out of a single deposit, how many multiple times a bank can create the loan and how it comes to the multiple times of that amount. We are going to understand. For that I need to show you one image. So now on the screen you are going to see the image, right? And I'll make you what is the CRR, what is the credit creation, and how the bank multiplies the amount.
So students, here you can see one table.
In the bank account.
In that table,
so here is the image.
you can see there are certain columns. The first column is the bank, the second is the net deposit, the third column is for required reserve rates, that means the reserve ratio, and the fourth column is of new loans. In this topic, we are going to understand how the bank creates the credit, that means how the banks create much more money. At first, the banks undertake this activity just to ensure that the supply of money is equivalent to the demand of money. That means in the economy, the demand and supply of the money are maintained very well, right? So whenever there is the demand of the money, the banks help the economy to give the proper supply of that too, right? And that's how the money is being balanced in the economy by the help of the banks. At first guys, you must be aware that whenever a person asks for a loan, what does the bank do? The bank never gives the cash to someone. The bank deposits that money by opening that person's account into the bank, deposits the money in their new bank account, and that's how the loan amount can be used by that person. After the amount is deposited in the bank's account, a person will be able to withdraw it and use it, and that money will be used in the economy, and that's how the supply of the money will be made in the economy, which has been generated by the bank. One thing I have told you before, that bank can make the credits, that means bank can create the credits, bank can give the loan from your own deposit. So one more term which is to be understood over here, it is a primary deposit. Whatever the amount is available in the different bank accounts, right? That means a person deposits some money into the bank, then that all deposits total will be known as the primary deposit. They are the basic deposits which are made by the people into the bank. Now bank is going to use that primary deposit to create credit and create loans and give it to another person. I just made you understood about the credit creation, right? Sorry, not the credit creation, but I just made you understood about the CRR, cash reserve ratio. On the basis of that, I would like to tell you that what happens once a person's primary deposit arrives. That means if a person is depositing rupees 10,000 into the account, the bank has the 10,000. So as of the rule, bank cannot pass the loan of 10,000 from one's deposit. Bank will have to keep some reserves of cash. So over here, say for example, the cash reserve ratio is 10%. At that time, from the primary deposit of 10,000, bank will be able to give the loan of 9,000 to someone, right? So again, if one person is availed the loan of 9,000, bank is not going to give them in cash. Bank will open the new account, and in that new account, those money will be deposited. So all the deposits are known as a primary deposit. So bank has one more 9,000 primary deposit, right? So from the second person's loan account, that means from that primary deposit of 9,000, bank will put aside 10% of cash reserve once more. So from that 9,000, bank will keep aside 900 rupees, and again 8,100 rupees will be given to third one. That's how from one person to second, second to third, third to fourth, fourth to fifth, the bank will make the credits. So when the borrower withdraws the loan amount from his or her account and that person is spending the amount, the supply of the money is increased in the economy, and that is due to the help of the bank. Now, as I told you just before, that a bank can never ever lend the full amount of the deposit. From every deposit, the bank will have to put some money aside for the proportion of money in the form of cash reserves, which is known as cash reserves ratio, right? That I just told you in the video only. Now, they can lend the remaining amount. After deducting the CRR, remaining amount can be lended. Right, I just give the example of 10,000 rupees, that from the 10,000, 10% was the cash reserve ratio. So from the 10,000, bank cannot give the loan of 10,000 rupees only. Bank will have to keep 1,000 as a cash reserve. So from the 10,000, 1,000 is cash reserve. So bank can give the loan of 9,000 to someone. Right. Over here, you have the example. On the basis of that, if I say, if the bank has a primary deposit of 1,000, and say for example the cash reserve ratio, which is determined by rule, and that is 20%, then bank can create the credit up to rupees 5,000. How? See, below the table there is a formula to calculate the credit creation. Credit creation is equal to primary deposit into 1 upon cash reserve ratio. So it will be 1,000 into 1 upon 20%, and that how it will come to 5,000 rupees. So from the amount of 1,000 of primary deposit, the bank will make more 4,000 rupees, and the total amount will be 5,000. That means the 4,000 extra credit creation will be done. Let's understand that from this example, from this table. Now over here you can see the bank A, B and C. So in the bank A, the primary deposit was 1,000 rupees, right? So from the net deposit of 1,000, the 20% is the cash reserve ratio. So we deduct rupees 200 as a 20% cash, and that's how the remaining balance will be 800. That 800 can be lended as a loan. I am repeating again, from the age deposit of 1000, 20% of the cash reserve is kept aside. That means 200 rupees will be kept aside and 800 rupees will be given as a loan. So now 800 rupees will be given as a loan. So for that 800 rupees, bank will open another new account as a B, and in that account bank will deposit 800. So it again will become the net deposit, the primary deposit. From the deposit of 800, bank will have to put aside the reserve ratio of 20%, that means 160 rupees. So the remaining balance 640 can be used as a new loan. Again from that 640, a loan is given to C, right? So 640 will be the primary deposit. From that 128 rupees, that will be 20% of 640, will be taken aside as the reserve ratio, and the remaining 512 rupees will be given as the new loan. So that's how from one loan another is created, from another third one is created, from third the fourth is created, and it will last longer. But we have to make sure that the credit cannot be created for more than the percentage which is given. That means the required reserve, the cash reserve ratio must be 1000. We had 1000 rupees cash in our hand, so we can make the credit creation up to the total cash reserve ratio amount becomes 1000. You can see in the total the 1000 is in the bold, right, of the required reserves, right? So required reserves or the reserve ratio of 20%, the total of them becomes 1000. Till then you can create the credit, afterwards you cannot, right? So from the net deposit, whatever the amount of net deposit was in the startup, you can make the loan out of it up to when the total reserve ratio comes to 1000, and that's how the creation can be done, right? So on the base of 20%, the bank worked well, the bank gave the loan on and on up to the total reserve ratio came to 1000 rupees. That was our actual balance, right? Until that time, bank made the credit, total credit of 4000 plus the reserve ratio 1000, and that's how the net deposit, which was just 1000, from that amount only the net deposit became 5000. Isn't it interesting that from the 1000 rupees, by using the rules only, bank created 5000 and gave 4000 rupees new supply in the economy. I hope you guys are quite clear with this concept now. Student, I think you are quite clear with the concept of the credit creation, right? It is easy to understand, and it was very much interesting to know that how the deposit of just 1000 rupees can be converted into 5000 rupees as of this example, right? So I hope you guys are quite clear with this concept. Now let's move to the fifth and the last function, the last primary function of the commercial bank, and that is interbanking transactions, right? The banks does not transact only with the consumers, they transact to each other too, many times, right? So when it is needed, the banks provide short-term and long-term credit to one another. The different banks, right? Say for example, the State Bank of India, the Bank of Baroda, the HDFC Bank, the Kotak Mahindra Bank, the Axis Bank, the IndusInd Bank. These all are the different banks. These all are the different business entities. But when in need, one bank can help another bank by paying some credit, by giving them some loan, right? So time to time it happens when the short-term credit is provided by one bank to another through the central bank, and that is called the call money. That means when the State Bank of India needs loan for short term, that means for 5 days, 7 days or 15 days, whatever it is, and Bank of Baroda gives the loan to SBI, right, being via the central bank. That means they are keeping the central bank in between as in the intermediator. The central bank is already aware about it, and it is must to be aware about it, right? So at first the Bank of Baroda is going to inform the central bank, that means the Reserve Bank of India, that I am going to give the loan to the State Bank of India, right? And once the RBI approves it, the BOB transfers the money from BOB to RBI, right? And that will be done as BOB gives money to RBI and RBI will give the money to SBI. That's how it will be done. So the money which is given from one bank to another by keeping the central bank as an intermediator, that money will be known as call money. You can be asked in the examination for 1 mark that what do you mean by the call money? So the simple meaning and the simple answer for that is the call money is which
the money being transferred from one bank to another as a loan for short term by keeping Reserve Bank of India as an intermediator. Now, the interest, definitely the bank is going to collect the interest over the loan which is for short term to another bank, and the interest on the interest rate for that money is being known as the call money rate. Right. So on the basis of the call money rate, one bank can avail the loan from the another bank, and they will have the central bank, that means the Reserve Bank of India, as an intermediator for this transaction. Right. So guys, these were the functions of the commercial bank, and these are all the primary functions. In the next session, we are going to conduct the session for the secondary functions of the commercial bank, and then we'll move ahead for the different topics. So till then, I would like to take your leave over here. I'm going to conclude my session. Right. Keep making notes, keep sending it. I'll see you in the next session. Till then, goodbye. Take care. Have a nice time. Stay home, stay safe. Goodbye.